You are not one bad decision away from financial freedom. You are one bad definition away from financial ruin. And the biggest lie you were taught is that investment is something you do when you finally have enough money, like it is a club with membership requirements. In 2026, that lie is killing people faster than inflation. While you are watching the market ticker and waiting for a better time, housing prices detach from wages, the job market gets rewired by AI, and your retirement gets pushed out like a debt collection notice. This is not financial advice. This is financial education, and I am going to tell you the uncomfortable truth about what investment really means at the level where money is manufactured, not hoped for. Let's start with a simple question. When you hear the word investment, what image shows up in your head? Stocks, a retirement account, a rental property, portfolio, maybe a hustle on the side. That is the public script. It is neat, it is calming, it makes you feel like if you just behave, you will eventually get rewarded. But the private script, the one the wealthy live by, is uglier. They do not treat investment like a hobby. They treat it like a weapon. They treat it like a role in a system that moves capital around with rules you never learned. And here is the part nobody wants to say out loud. In that system, the word investment is not mostly about money. It is about power. It is about who gets to deploy capital, who gets to call the shots, and who gets stuck holding the bag when things move against them. In the next few minutes, I am going to walk you through how the wealthy define investment, why most people are not even playing the same game, and how modern 2026 realities like AI job displacement, the Federal Reserve interest rate cycle, and the housing affordability crisis have exposed the scam inside the everyday definition of investing. And to keep it real, I am also going to tell you why your common sense strategy keeps failing in the long run. Not because you are lazy, not because you are stupid, but because you were handed the wrong playbook on purpose. Now let's get into it. Start by redefining yourself. Most people spend their whole life trying to answer the question, how do I invest? But the real question is, who am I in the money game? Because your identity changes your risk tolerance, your time frame, your patience, and your ability to access opportunities. You might have all the right tools, but if you are playing the role of a customer, you will keep getting treated like one. Think about it this way. Investment is not only what you do with cash. Investment is how you allocate your time, your attention, your energy, your emotion, and your credibility. You invest when you decide where your mind goes every day. You invest when you decide who you talk to. You invest when you choose the skill to chase and the pain you refuse to endure. If you grew up in the middle class, you were probably trained to treat money like a scoreboard. You earn, you save, you invest a little, you hope. That is not investment. That is participation in someone else's game where you are usually the losing side. The wealthy treat money like fuel. But more importantly, they treat the ability to deploy money like leverage. That is why two people can both buy the same thing, and one gets richer while the other ends up stressed, indebted, and stuck. And here is a pattern interrupt. In 2026, you can see the mismatch everywhere. You can see it when people learn to code after being told by influencers that AI is the future. Then AI shows up and codes faster, writes documentation faster, and automates entire workflows. If your plan was just to learn a skill and then sell your labor, the market is now treating you like replaceable inventory. You can also see it when the Fed cuts rates on paper, but your paycheck still buys less. You can see it in the numbers that rarely make headlines. Real purchasing power after high inflation does not rebound neatly, it grinds. Even if interest rates stabilize, the damage to your cost of living remains in your groceries, your insurance bills, your rent, and your monthly mortgage payments. So if investment is identity and role, what is the role most people choose? They choose the role of the small player, the person who puts in their money at the end after the plan is already built, the person who buys shares in a company they do not understand, the person who hopes their timing is lucky. Meanwhile, the wealthier role is the person who builds the game, or at least positions themselves close enough to the lever that they influence outcomes. Now let's talk about the definition that changes everything. People say investment is when money makes money. That sounds right. It also sounds like a guarantee, but it is dangerously incomplete. In real terms, investment is when you structure an outcome so that the downside is limited and the upside is engineered. Speculation is what you do when you believe the outcome will be favorable, but you have no control over the mechanism. Gambling is what you do when you chase uncertainty with no plan for downside. Here is the cold truth. Many people in 2026 are not investing. They are speculating with better branding. Buying a stock and hoping it rises is not the same as owning an asset backed by a cash-generating business model you understand. Renting a property and believing the rent will cover the mortgage is not the same as calculating vacancy, maintenance, insurance rate spikes, property taxes, and the local economy. Even if you receive income, the income can still be a trap if your asset is overvalued and your costs keep rising faster than your yield. So what does real investment look like in practice? Let's get concrete. Imagine you buy a rental property with the intent to cover all operating costs and the mortgage with rental income. You do the work before the purchase, not after. You model how long it will take to break even. You account for the real world, repairs, tenants leaving, interest rate swings, insurance hikes, and taxes that can jump. You structure the deal so that even if the market is volatile, the cash flow is still doing its job. In that scenario, you are not betting on luck. You are operating a system. You create recurring cash generation. Then you do what wealthy people do. You recycle capital. You might refinance when rates allow. You might use the property as collateral to scale. You might sell part of the position when it has served its purpose. The point is not the property. The point is the mechanism of money working across time. Now compare that to a different scenario. You buy a property because it always goes up, or you buy a stock because the chart looks bullish, or you buy crypto because this time it is different. You are treating the market like a slot machine where your job is to press the button and hope. That is not investment, that is exposure to randomness. And randomness is where most people lose, especially when you are using money you cannot afford to lose. Now you might say, okay, but I do not have capital. That is the usual dead end. And here is where a lot of people get misled by motivational content. They tell you you can invest with no money. They sell you the idea that anyone can jump into wealth by watching a few videos and taking a risk. No, not in the way that matters. Real investment has thresholds. Not everyone is allowed into every game. That is not elitism. It is mechanics. Capital markets, real estate deals, and business formation all require minimum resources, either cash, credit, collateral, or credibility. If you do not have any of those, what you are doing is usually a side quest disguised as a main mission. But don't stop listening. There is still a path. It is just not the fairy tale path. You can still use the wealthy mindset while you do not have wealthy money. That means you think like an investor. You stop asking only, how do I grow my own money? And you start asking, how do I create a situation where someone else deploys money, and I manage the outcome or the process? That is where the game changes. And here comes another pattern interrupt. In 2026, you are surrounded by opportunities to manage processes, content, distribution, and customer acquisition. Because the internet is not just a place to post, it is a place where attention becomes revenue. If you can build an audience or build distribution, you become valuable in the exact way businesses need in order to scale. A business that needs customers will pay for customers. That means if you have 1 million people paying attention and you can convert a portion of them into buyers, you can become a channel for advertising, sponsorship, lead generation, and sales. That is not passive income. It is active leverage, but it is the kind of leverage where you can start without owning billions. The wealthy are not magic. They just understand leverage earlier and they structure incentives more cleanly. Now let's escalate the stakes. I want to tell you a story because this is where most people break. Picture a 32-year-old nurse named David. He has student debt. He works shifts that ruin his sleep. He checks his bank balance every morning like it is a weather report. Then one day he hears that he should start a business because it will create wealth. He gets excited. He calls a friend. He sketches plans. He wants to open a small restaurant that caters to tourists. David estimates he can invest $30,000. He thinks that is all in, but in his mind it is still manageable. Then he asks you for permission. He asks, do you think this is a good idea? And here is the uncomfortable question you should ask before you approve any plan like that. Is he building an enterprise, or is he also building a financial trap disguised as ambition? He wants to do two things at once. He wants to start a business and he wants to invest personal money. That is a dangerous combination when you are financially exposed, because if the business fails, he does not just lose money, he loses time, reputation, and confidence. He loses the ability to pivot. He might even lose the ability to keep paying the bills while learning. And in 2026, this problem is worse because failures are faster. Customer acquisition is more expensive. Competition is more ruthless. AI tools reduce the margin for error because the market expects you to move quickly and cheaply. If your operation is slow, the algorithmic economy will bury you. So why do people keep doing this? Because they confuse starting something with investing. Starting something with your entire personal bankroll is not bravery. It is leverage suicide. Now compare a different approach. Imagine David still wants the restaurant, but instead of using his life savings, he structures the deal so that his personal risk is limited. Maybe he finds partners who bring capital. Maybe he negotiates a lease structure that reduces upfront costs. Maybe he focuses on revenue contracts before building out the full operation. Maybe he becomes the operator and distribution manager while others finance the build. Does that sound more complicated? Yes, but that is what real investment mindset looks like. It treats capital as a tool to be allocated, not a trophy to be thrown into uncertainty. And here's where anger is justified. They knew this. They always knew this. And they still let public education push the story that you should invest your last money into a dream because it makes for inspirational content. In reality, there is a reason poor people keep getting told to take personal financial risks. It keeps the wealth transfer moving in one direction. Now we are getting to the heart of the matter: how wealthy people actually invest. The wealthy do not just buy assets, they orchestrate capital. They arrange deals where capital comes from other sources while they control strategy, operations, and outcomes. People like Warren Buffett are often treated like symbols. But you need to look at the mechanism. Buffett did not become powerful and then learn to invest. He built a system around investing and around capital access. He positioned himself like a manager who can deploy pools of money. And once you can manage money effectively, other people want access to you. That is not just finance. That is marketing. It is relationship capital. It is trust. Marketers would call it distribution. Wealth managers call it capital raising. Same mechanism, different language. And now here is where it gets really ugly for everyone who thinks wealth is built from personal savings. If you want to be a serious investor, you eventually need to learn how to get other people's money to work for you. That does not necessarily mean you are stealing. It means you are operating in a world where capital is deployed by institutions, partners, lenders, and investors who demand returns. If you cannot access capital, you are not an investor yet. You are a risk taker. In 2026, you can see how this plays out in the biggest trends. AI eliminates middle-class jobs, but it also creates demand for people who can manage data, distribution, customer pipelines, and integration systems. In that environment, firms need funding and they need expansion. That means investors who understand risk allocation can scale quickly. Housing is also a clear signal. People cannot buy homes with wages alone, so capital structures change. Bigger players use leverage, financing, and partnerships to secure assets while first-time buyers get crowded out. When rents are high and insurance markets collapse in some regions, wealthier investors pivot faster because they can absorb volatility. Inflation came down on paper, but purchasing power still feels broken. That means cash flow strategies matter more. Anyone who relies on growth fantasies is exposed. Investors who know how to engineer yield will survive longer. So the mechanism is constant. Deploy capital, manage risk, structure outcomes, and scale the process. Now we have to talk about the psychological barrier that keeps you from doing this. Many people feel ashamed of debt. They were taught that borrowing is immoral. They feel that taking other people's money means you are a failure. Let me tell you what that belief costs you. It prevents you from learning the real game. In the real world, companies use financing. They issue equity. They raise venture capital. They borrow. They lease. They use operating leverage and they negotiate contracts. Even the most successful investors operate through vehicles and funds, which means other people's money is part of the machine. The only difference is that the public story is simplified. Influencers make it look like wealth is created by a lone genius saving patiently until they can buy a ticket to the rich club. That is a comforting lie because it lets you avoid the scary truth. You do not become rich by buying, you become rich by arranging. And here is a cliffhanger, because this is where the real trap hides. People who believe debt is shameful will refuse to structure partnerships. They will not learn to pitch, they will not learn to negotiate, they will not build a track record. So when the moment comes to scale, they cannot. And when the market shifts, they freeze. You are not lazy, you are not stupid. You were just never given the real playbook. Now I want to connect this directly to modern 2026 conditions, because the environment is not forgiving. The Fed controls the cost of borrowing and influences liquidity. When interest rates are high, leverage strategies get squeezed, mortgages become expensive, refinancing becomes harder, businesses feel it, consumers feel it, but the wealthy do not panic the same way because they do not rely on one income stream. They rely on portfolios of assets, partnerships, and financing options. When the Fed cuts rates, you will hear that the market is rallying, but the market is not your life. You can watch stock indexes hit highs while average workers face stubborn expenses. That disconnect is not accidental. It is the design of how capital allocates. Asset owners benefit faster than wage earners. This is the wealth concentration story. In 2026, the top 1% owns more than ever, not because they are morally better, but because they can borrow against assets at relatively low rates and keep accumulating while everyone else is forced to sell time for wages. And now connect this to AI. AI reduces the bargaining power of certain job categories. It makes labor more substitutable. That pushes more risk onto individuals. Your income becomes less predictable, your training needs become shorter, and your safety net can feel thinner. So if you are still thinking investment equals using my own money, you will keep running into the same wall. You cannot accumulate enough capital fast enough, and the environment keeps changing faster than your savings plan. Now we need to talk about the investor class versus the middle class mindset. The middle class mindset says, save money first, then do something. The investor class mindset says, build systems that bring capital in first, then allocate money to build the outcome. This is why two people can both start a project. One person uses their own money like a life raft. The other person uses other people's money like a conveyor belt. If you do not have capital, the conveyor belt is not available unless you build a role that others want to fund. That role is usually distribution, execution, or credibility based on outcomes. In plain terms, investors ask, can you produce results? Can you protect cash flow? Can you reduce uncertainty? Venture capital funds in particular understand that many startups fail. They fund a high number of risky projects because they are betting that a small number will massively outperform. It is portfolio thinking. It is not a promise of success. It is math. So how do you become fundable? You stop thinking about your dream as a personal story, and you start thinking about it as a business plan with risk controls. You show traction, you show customer demand, you show margins, you show how you avoid catastrophic burn, and you communicate in the language of cash flows and survival. Now here is another pattern interrupt because we are close to the darkest part. People think crypto was supposed to free them from banks, but in 2026 crypto is more controlled than most retail investors realize. Regulation has pushed much of the market into institutional channels. Exchanges and custodians grew, and institutional players learned to dominate liquidity. Retail investors still chase freedom, but they often end up as exit liquidity. So when someone tells you crypto is a strategy for the average person to become an investor with no money, be careful. Ask who controls the infrastructure. Ask who captures the fees. Ask who has custody. In many cases, banks and large institutions have more power in crypto markets than the people buying tokens on their phones. That again ties back to capital access and infrastructure control. If you cannot influence those, you are not escaping the system. You are just participating in